Good morning. Thanks for being with us here at the Oil and Gas Conference. Our next presenter is Jonathan Wright. He's president and CEO of NuVista Energy Limited. He's been president and CEO since May 2011, has a lot of experience, 30 years of experience in oil and gas. Jonathan, welcome. We look forward to your presentation.
Thanks, Dan. It's great to be here. So, yeah, thanks, Michael. If we can pull up the slides, that's great. We can just go to the next slide there. I just need to, yeah, you can go to the next slide. Thank you. Just need to quickly draw your attention. We're going to be talking about forward-looking information. So, of course, please pay attention to the advisories in the pack there, Michael. And on to slide 2. So, yeah, I'm just going to do a quick, 8 or 10 minute introduction to the company here for those that might be less familiar. And then I'm sure in the Q&A, we'll get into some of the good details, especially for some of you that may be more familiar. So as you can see here on this slide, we're about a 50,000 BOE per day company, and we've kind of grown from zero to hero in the Montney in Alberta over the last number of years here, growing organically by drilling some great horizontal wells into this exciting play. And you can kind of see some of our key stats shown on the screen there. We are holding our production flat right now because it's been a tough year, and we'll talk about this COVID-19 type year that we've had. But one of the things we had to do was cut our capital investment. So we entered the year with 330 million of cash flow expected, and we were going to spend all of that on 15 to 20% of growth in the Montney. But of course, when COVID-19 and the Saudi-Russian oil war hit, oil price war, we decided to dial things back, of course, to protect the balance sheet first. And that's what you're kind of seeing there as we cut our capital roughly in half, with very little capital investment needed for the rest of this year in order to therefore just keep production flat. So I'll get into some of the details of that, but you can see that our production is all centered very close and compact near the town of Grand Prairie, where we have a large amount of oil and gas services available. And all of our production is 30 to 60 minutes away from town there. So a nice compact production area. Next slide, please. So as you can see here, let's zero in on the neighborhood a little bit. We are very much in the condensate rich trend, as you can see here. And some of the neighbors that we produce near are also part of this exciting play. And that's why there's a lot of activity, which means a lot of learnings in terms of the horizontal wells that have been drilled. We don't have to learn just from our own wells. You can see here, if you look in pink at the bottom, that's 7 generations. You may be familiar with them. At the top, we've got in light blue there, that's Encana, now called Ovintiv, of course. And then we've got Paramount, Canadian Natural Resources, and several other companies in the area producing on this great condensate rich trend that we produce. And as you can see here on the left-hand side, it's still been an area of a lot of activity, even though activity in the industry in general has been reduced this year worldwide. And you can see in the bottom left-hand side, you can see that we're over 1,200 wells producing in this small area now. And that's about 1 3/4 BCF a day of production, which is, something like 15% of the 10 to 15% of the basin production for Canada, Western Canada in total. So definitely an exciting area. And a big reason for that is the large amount of condensate content. So not only do we have a resource play, highly repeatable, high rates of gas from these wells, but 1/3 of the production is actually condensate, which is a very light oil that's used as a diluent for the oil sands in Alberta. So we are where the market is, which means we get full West Texas pricing for that light oil called condensate. And so although it's only 1/3 of our production, it results in 2/3 of cash flow and is one of the biggest drivers of why this is a powerhouse economic play. Next slide, please. So you can see here, if we zero in and just look at, we've taken off all the competitors now, and we're just showing our lands in yellow. And you can see between the two rivers, that's where our legacy lands were, and we've had great production growth in there, growing to 50,000 BOEs per day. But our next big growth area is actually north of the river, and you can see that's called the Pipestone South and Pipestone North area in blue. And we bought that Pipestone South land a number of years ago before people realized how exciting this area was going to be. And then we did a purchase of the Pipestone North area 2 years ago from Cenovus Energy to expand our presence there in a big way. And the reason we want to do that is we're seeing very good condensate rates and therefore excellent economics in the north of the river area, the Pipestone area. but we also have significantly lower well costs because it's aquifers you're drilling through above the Montney, much quicker drilling and a little bit shallower, so much cheaper to drill than south of the river. So we'll be holding most of our production flat south of, in between those two rivers and north of the northern river, the Wapiti River there. You'll see that in Pipestone, that is where all of our capital allocation is going forward. Next slide, please. So you can see on this one, I talked a little bit about condensate, and this just talks a little bit about why condensate is so valuable, and this is very different than the Permian. And the reason is we actually, for most of our products in Canada, we're at the wrong end of the pipe. We have to export to the U.S. Gulf Coast, and therefore we pay the tariff to get there, and we suffer the discount to pay that. Whereas for condensate, we actually are making it in Alberta, and we're using it in Alberta. And it's very important because it is used as a diluent for the oil sands here in Alberta. And there's such a big demand for it, as you can see there on the two graphs on the right-hand side. The actual demand is at the top of the gray in the bottom graph there. Sorry, that's the oil sands demand, but the blue is actually the supply within the province. And so we can't supply anything more than about 2/3 of what's needed in the province, and therefore the rest has to be imported, actually from Texas and Chicago area. And so finally, we're at the correct end of the pipe for one product, which is condensate, and that's why it's so profitable. We benefit from the premium there, and others south in the states have to pay the tariff to get to us. So a great place to be right here where the market is. Next slide, please. So now let's talk about, the pivot that had to happen this year. I think all companies had to pivot. We entered the year with $330 million of expected cash flow. We were going to spend almost all of that and grow 15 to 20% per year as part of our continuing growth plan to increase our returns as a company. And we needed to pivot from that very quickly when we saw the Saudi-Russian oil war and the COVID-19 crisis hit. And fortunately, we're a nimble company, and we were able to pivot very quickly. And you can see the key things laid out in this slide that we had to do. So first of all, we leaned on our hedges. We always enter the new year very well hedged. We were 65 to 70% hedged for the year on all of our products, basically our natural gas and our condensate. And as a result of that, we were able to dampen the downside. It gave us some time and some extra cash flow to deal with the lows of the low that happened last quarter here. So we made a decisive move in terms of flexibility. As I said, we scaled our CapEx down in half for the year. But since the winter drilling season is very busy in Canada, we'd already spent a good portion of our capital. So what it meant was we actually made a 75% reduction in the capital for the remainder of the year. And so a big cut. The other thing we did was we deliberately held our production flat. So instead of surging it up to 60,000 BOEs per day from 50, which we were capable of doing with the 15 new wells that we had brought on stream, we chose not to do that in a low price environment and go for value first. We restricted that production. And because we've cut our capital, it means we can just feather on that production throughout the year to offset natural declines in our base production and keep things flat without any more material capital spending. And so this is a very positive position, and it's already worked favorably for us because now we're producing some of that condensate and natural gas that we would have produced in Q2. And of course, we would have had much lower prices in Q2 for that. So we're sticking to that plan. We're quite happy with it thus far. Financial strength is really important. We went in with $240 million of liquidity into this crisis, which is good to have a huge cushion like that, because during crises, you need to use a bit of it. And so we did see in Canada and in the US, bank lines were reduced across the board. We had a fairly light reduction from $550 to $475 million Canadian. And so fortunately, we had still had more than enough liquidity, even during the worst quarter, which was last quarter for pricing. I think we know West Texas went negative, and NYMEX pricing for gas was also very poor. So having come through that with our minimum liquidity still being enough, it's onwards and upwards from here. Because with our minimum capital spending and with our good hedges, we're actually paying back $50 to $60 million, using our free cash flow of $60 million this year to pay down our debt through the rest of the year, because we always put the balance sheet first. I talked about the 15 wells that we brought on stream, and we've been feathering them on production. But in addition to that, we have 14 DUCs, 14 drilled uncompleted wells that we originally planned to complete this year, but we pushed that off into next year as a result of the crisis that's happened here to reduce our capital. And so what that means is next year we'll be able to do very well, and I'll talk about that on the next slide. And so really, if you kind of summarize, what we're talking about here is the ability this year to stay flat and pay back $50 to $60 million of our debt with our free cash flow of $50 to $60 million. And if we saw prices staying low, like $37 to $40 West Texas, for another year, for a full 2 years, we're still able to stay flat through next year and stay within cash flow next year. And if we go to the next slide, we can talk about that. Next slide, please. Thank you. So when you look at slide 7 here, you can see what we were doing this year. We did finish all the pads we were in the middle of doing when the crisis hit, but we deferred a Bilbo 2-well pad and a Pipestone North, a 12-well pad, which had been drilled. We finished that drilling through the end of the first quarter and the beginning of the second quarter, but we deferred the completions for those into next year to conserve capital and because we didn't need or want to grow in this low price environment. And so that's what really those arrows in gray are showing to you there. And that's why the remainder of this year, we only need to spend $15 to $25 million through the second half, allowing us to have that nice free cash flow to pay down some debt through this year and put the balance sheet first. Now, the key thing is those 14 drilled uncompleted wells, those DUCs, we get to carry those into next year, and that allows us to therefore bring on production to offset declines next year and keep our production flat as a corporation for a very, very low amount of capital because we don't have to drill those wells. They're already drilled. And so we'll just complete them and tie them in. And with our continuing reduction in costs that we've been seeing in our drilling and completions activities, it means that next year, even if oil prices are only $37 to $40, we're going to be able to spend our cash flow, not increase our debt, stay within cash flow, and still have enough production coming on to offset decline and stay flat for a second year. Now, that said, I don't actually expect that to be a case. It's good to have a defensive downside case like that, but we're already seeing strengthening in prices, and we believe, like many do in the world, that supply has just been crashing, and therefore supply and demand are going to cross back again, and we're going to see continued strengthening in prices. I don't personally ever try and pick the timing on these things. That's why we have this defensive plan until we see things really improve, but I really do believe we're going to be seeing $45 to $50 West Texas at some point 6 and 12 months from now. And when we do, that provides us significant extra free cash flow to be able to get back on our prudent growth plan. So if we go to the next slide, so you can see on this one, 2 years ago when we did the Cenovus acquisition, we laid out this growth plan. We showed we had more than enough inventory to get to 110,000 BOEs per day, and we signed up capacity for those for our facilities, and we built compressor stations, and we signed up midstream capacity to be able to grow to at least 90 of that 110. And then shortly after that, the world really went away from desiring growth. And so we haven't signed up any more capacity since then. And fortunately, the capacity we signed up is flexible. And so you can see we have capacity in our facilities now that we've built for 90,000 BOEs per day. We're currently sitting at 50, holding ourselves back from 60. And we have the ability to grow to 90. But as you can see in the dotted line, the minimum volume commitments that go with that are quite manageable and are significantly less, around the 70,000 BOE per day level by 2023. And so what we did as part of our conservative plan here is we've been renegotiating with the midstreamers to basically lengthen our commitments but reduce them in the short term so that we can basically have even more flexibility on that dotted line. So stay tuned for more information on that. But basically, if we needed to stay flat for 2 years, if things did take a turn for the worse on pricing, we can easily do that. But the good news is we actually think pricing is going to be rising, and therefore we're going to be able to fund our growth plan and stay well ahead of that dotted line. And ultimately, our company is most efficient at 70 to 90,000 BOEs per day because full facilities are happy facilities, and you have your costs at minimum. So if we go to the next slide. Thank you. So this is the last slide, and then we'll just go to some Q&A. I just wanted to quickly make the point that sometimes gets overlooked, which is, ESG has been a huge topic for investors worldwide in this past, especially in this last 1 to 2 years. And I'd like to say that NuVista has always been quite proactive in this area. And in fact, Canada is one of the top performers in the world from an ESG point of view, just because of the high standards that we do have. And so I just wanted to point out, like for us, this is like breathing, and we're now putting more and more emphasis to highlighting it for investors so they can realize the kind of huge upside from an ESG point of view we already have in Canada. And I've just put a couple, it's such a long topic, but I've just put a couple of things highlighted here from one of our corporate slides from our presentation. There's a number of things on here, but as you can see, we've been very much working on our greenhouse gas intensity. We've got a number of projects we do to reduce our intensity over time here. And in fact, from a methane point of view, we are going to be reducing further into the future, and we've already cut as an industry more than 40% since 2012. Methane, obviously, a big producer of greenhouse gas, a big contributor to greenhouse warming. And then water recycling. We have a lot of fresh water availability in Canada, but we don't rest on that. And we are always working on reducing freshwater use, finding brackish supply, non-fresh supply, and finding ways to recycle our water. So we've spent a lot of time and money on that. On the social side, obviously, our communities around us are very important to us, whether they be the First Nations communities that we work with and around, or the other communities in cities and towns near where we work. We're always donating and supporting education and family initiatives in those areas. And then finally, from a governance point of view, Canada is very strong for governance, and protecting shareholder interests is at the foremost of that. And a big part of that is, of course, executive compensation is directly tied to shareholder returns. So that's something that's always going to be important. So just a quick smattering on that one. So I think that's a good time to kind of pause there and just go back to Dan, and we can do some Q&A. I'm happy to answer any questions that you may have.
Jonathan, thank you very much for that presentation. Very informative. And I want to start off with, we've seen now a couple of presentations from our Canadian friends, and so much of the discussion from the investor's perspective is focused on the U.S. plays, particularly the Permian. Tell me a little bit more about why investors should pay attention to those, or to NuVista, the Montney play up there in Canada.
Yeah, that's a great question. Like it's an area that maybe gets overlooked by some U.S. investors because Texas is right there, and the Permian's been such a great play. But we have our own, I was going to say little Permian in the Canada, but it's actually a very, very big Permian. We have this massive play, which, if you think about it, it's certainly of the same scale and returns of the best of the Permian. And yet, at the same time, it's far, far less drilled, like 10 times less drilled. Less capital has gone there. So there's a lot more inventory left. There's a lot of room to do well spacing and learn from some of the parent-child issues that have happened south of the border. For example, when money gets spent more quickly, we in Canada get to watch that happen and learn from it while we're going at what I would say is a little bit more of a prudent pace that Canada has always kind of grown at. And our company is no different. We've always been growing at these 10 to 20% per year type growth rates. So a couple of specifics to give you some examples that back up what I just said. For example, at $40 to $50 West Texas, you're talking about returns on these wells, which are 50 to 100% internal rate of return. Now, those are half cycle numbers, but I'll just point out for our company, we've already built all the facilities, so the capital is sunk now. The full cycle returns are also good, but it's kind of irrelevant now because it's behind us. We built the facilities, and all we have to do is half cycle spending in order to get those returns. And those are excellent returns to get in a $40 to $50 per barrel West Texas environment. I talked about the running room. To give you an idea, we have 4 benches. I know the Permian has multiple benches. We have 4 benches to drill, and we have in a number of our areas drilled, stacked cubes of wells, basically all 4 zones drilled one on top of the other at the same time for all the cost efficiencies that brings. And then, the other thing I would say is well results and efficiency continue to improve. So we've seen continuing learnings from watching the Permian, the Marcellus, and of course all the Montney wells and other plays that get drilled. And so we continue to get better at fracking these wells, the cluster perf patterns, the plug and perf approaches, the cased cemented cased liner design. All of these things have continued to get better. So our wells continue to improve. We continue to get longer. The longest well that we've ever drilled is 3.25 miles long, actually open hole horizontal in Canada here, drilled by NuVista. And we average most of our wells are 2.25 plus miles. So of course everyone knows that when you go longer, those are the cheapest extra feet to drill, and therefore really help your efficiencies. So all that results in not just improving well results, but very importantly, crashing well costs. And one last example I'll throw out there is that 12 well pad that we just drilled at Pipestone North. It's the biggest pad we've ever drilled. So we got some of the best efficiencies and learnings that we've built on for the last 9 years of drilling. And we actually drilled that one for 45% less cost per foot drilled than all of the wells that we drilled in 2019, just the year before. And that's a combination of efficiency, length, and also the fact that north of the river, as I said, we're a little shallower and a little easier drilling in that rock, and therefore we were just able to do it faster. So tremendous for economics when you've got costs falling and results increasing.
Yeah, that's impressive in terms of cost efficiency. A couple questions coming in online that I want to talk about the acreage in the Montney. And this is a twofold question. How do you think about allocating capital between your different areas within the Montney? And with that question, how would you rank the lower Montney zone in your opportunity set?
Okay, great. So in terms of capital allocation, we're going for the best returns. Like when prices are very high, you know, these 50% returns that we're getting, for example, at $40 West Texas, they turn into 100+% when you start going to 50 and 55 West Texas. So when you've got higher prices, we're more preferring to drill the entire cube, the entire stack, because you're getting maximum resource capture, and all of your returns, even though they vary across the different zones, and generally our upper zones are the highest return, all of the returns, including the lowest return, are so good that it's worth capturing all of that. But I can tell you in the $40 and less environment we've seen through this year, we go to a very different pivot, which is we're not going to drill any of the lower return zones, and we just go for the best of the best, because of course returns are not as good at $40, and they're very poor when you're at $20 and $30. You're just drilling enough to basically keep things flat, as I talked about. So that's one thing on capital allocation. And then the second thing is geographically. The reason we entered the Pipestone North area, we had to take a bit of time to get those facilities built, and that's done now. We built Pipestone South. Pipestone North is almost finished and ready to go. And the reason we did that was because, as I said, it's cheaper to drill up there, and yet we get similar returns to the best areas south of the river. So similar to your best returns, and doing it for a lot less cost is, of course, much better internal rate of return for those wells. So that's where all of our capital allocation is going. All of our properties south of the river, we're pretty much just going to be drilling them as the oil price rises here. We'll be drilling them to stay flat, whereas the growth will come at Pipestone North and Pipestone South, which is our large growth area with our highest returns. The last part of your question was, what about the Lower Montney? Lower Montney is the emerging zone. Like of those, I'm trying to remember the number now, of those roughly 1,500 wells that have been drilled in our immediate area, there's probably only 40 or 50 of them have been into the Lower Montney. That's the new zone that just started getting tested out. Ourselves, we're up to something like 5 or 6 wells in the Lower Montney now. And so we've stopped drilling the Lower Montney when the oil price fell, because we're just going for returns. We're just going for those well-proven C and D zones, the top 2 of the zones. However, you know, certainly in the future, we're going to continue to pop the odd well in to continue to learn about the Lower Montney. So the Lower Montney has great potential. It's looking good. We're very pleased with the type curve results we've been getting from it. It's just that until more wells go into there, you know, it's kind of still a little bit of a delineation zone, and therefore you have to attach a larger risk to the economics that you're applying. And so Lower Montney is looking great. It's got lots of upside, but since we have more than enough inventory until oil prices are at a higher level, we're focused more on the B, the C, and the D zones above the Lower Montney.
All right, great answer. Definitely a complete answer. One thing that we hear a lot about, you know, and investors here down in the States is that you guys have a pipeline egress and takeaway issues with your production, and that drives significant discounts on the hydrocarbon. What would you say, and how do you explain that? What's your thoughts on that when you're talking to investors about offtake?
Yeah, for sure. That's definitely an issue that Canada has had, and it's a fair criticism. A couple of things are different, particularly for NuVista and our peers in the area in the Montney there in the condensate-rich trend. So first of all, there's a difference that's true for all of Canada, which is because of the COVID crisis, everyone has pulled back, supply isn't as much, and so now all of a sudden, where we didn't have pipeline space for egress and we're waiting for the next one to be built, which is Trans Mountain Pipeline, shovels are in the ground, it's being built. All of a sudden now we actually do have space. So temporarily we have space and the next pipeline is finally on the way. So that's good news for industry. But in the near term, that'll help. In the long term, though, we were always in the best position. I think I alluded to this during my presentation. The condensate, we only make 2/3 of what we need to use in the province as diluent for the oil sands, because you have to dilute the heavy oil from the oil sands to be able to pump it down the pipes to the Gulf Coast and to the other areas where it gets pumped. And so our condensate is used for that, and therefore the demand exceeds. We only produce 2/3 of what's needed in the province. So we're actually finally at the correct end of the pipe. We're at the import end of the pipe for condensate only. So that's our primary product. That's 1/3 of our production and 2/3 of our cash flow. And that is set in exactly the right place, which is tremendous. Now, natural gas is 2/3 of our production and 1/3 of our cash flow. So it's also important, and that's why NuVista has been one of the most proactive companies. We've taken export pipe, long-term export contracts to the 5 points of North America. So that's the U.S. Gulf Coast, Chicago, Dawn, Malin, California, Oregon, and also we keep some of it here in ACO in Alberta. So we have a diverse set of contracts, and all the details are in our corporate presentation there. There's a map that shows where it all goes. But the bottom line is that allows us to get to the diversified markets. We have guaranteed access through those pipes. And yes, it's true, it's difficult to get the next pipe built economically, but we don't need that because our entire growth plan that I showed is underpinned with the contracts we've already signed on existing pipes.
Great. You have a lot of inventory in the Montney. Can you expand a little bit more about the parent-child issues? You've certainly seen them develop down in the U.S. plays. You mentioned it there, that you guys still have plenty of elbow room. What are you seeing with respect to parent-child issues in the Montney, and what have you learned over the last couple of years on that?
Yeah, a couple of things. Obviously, it's best to drill cubes. In other words, drill all your wells in all your zones all at once, and then frack them all at once, get them on production. So that's the best thing, because then it's all virgin rock. In some cases, you can't do that because you're still testing out, for example, the lower Montney zone. You don't want to invest as much capital until it's more proven. Or, for example, you drill one pad and it produces for 6 or 12 months, and then you drill the next pad. And so you're going to have some parent-child, some drainage on the nearest well to the next pad where you now drill. So that does cause issues in terms of depletion and also frac efficiency, because you can't frac as efficiently if you've got a thief zone like a depleted zone. So to cut a very long story short and make it simple, first of all, we try and drill cube style when we can, but I explained economically we have to respond to the environment. So sometimes we don't do that when the prices fall, for example. And the other thing is, even when you're drilling the next pad, you still have to, and the solution is to create larger spacing. If you're far enough away, you don't have parent-child issues. We've learned that by watching the US plays and some of the Montney plays, and we've learned that from our own wells. So in a nutshell, we've seen spacing drilled in some of the plays down as low as 500 feet apart, 500-600 feet between wells. That's horizontally between the two wells. And in the same zone, in most plays, that starts to cause problems. And I would say the Montney is no different. We found that the sweet spot where you really get limited parent-child issues is, so we typically drill 800 to 1,000 feet between wells. So we have a nice drainage area, and when they're drilled at the same time. And we tend to push it up to more like 12 or 1,300 feet between wells if we now have a new pad going beside an old pad. So there is the potential for parent-child issue. And we find that nearest well still tends to underperform by a little bit, but not very much. Whereas if you get very close together, you can get 30, 40, 50% reductions in efficiency. So really, it just comes down to we've got more than enough inventory. To give you an idea of inventory, we have about 1,100 wells in our contingent resource inventory, and we drill 20 to 30 per year. So it's a huge inventory of wells to drill, so we can cherry pick and we can space appropriately to make sure we're getting the best economics.
Sounds great. Have a few more minutes left, and here's a question. Can you describe your efforts to reduce your processing and takeaway commitments? And after that question, I kind of want to spend just a minute on ESG. So efforts regarding processing and takeaway commitments.
Sure. So, in a 45 rising to 50 world, our commitments are fine and we wouldn't want to change them. And so we still got that capacity to go with. But we wanted to make sure we had a defensive plan if things were to stay at sub $40 for, say, 2 full years. We think that's very unlikely, but it's important to have a plan B. And so we went to all of our midstream providers and just said, guys, if things are sub $40, we don't want to be forced to grow. These original contracts don't make sense in that environment. Can we work together on this? And they've taken very much a Team Canada approach. They realize that they need healthy producers for 20, 30, 40 years, and they're taking the long run view. So long story short, they're working with us to basically reduce the amount of commitment in the short term without reducing the ability to go more than that as prices recover. So we've still got all the capacity. And in return for that, of course, it's got to be a win-win. And so what we're doing is looking at extending the commitments that we made to them for longer. So from an NPV basis, they can see a fair deal there as well. So that's been going very well, and we look forward to making some announcements on that in the near future.
Yeah, and I don't want to leave this without giving you the opportunity to kind of maybe expand on your ESG commitment and the strategy there at NuVista. You can definitely flesh out a little bit more of the E, maybe G, and then kind of focus in on the S side when it comes to underrepresented groups in oil and gas. How are you outreaching to that? What is your service to the community on the social side of that?
Sure. Yeah, a couple of quick ones there. I talked about some of the reductions we've been making. Because our facilities are sour, the first thing is we have monitoring everywhere for the sour gas for safety reasons, and we have Loctite facilities. All of our tanks, everything are very, very tight compared to a sweet facility. So as a result, we have very, very little for fugitive emissions and for methane emissions. So we're already starting from a world-class place. In addition to that, we're laying out an internal pathway to see, can we get to zero? Can we get to zero methane emissions? Because we're already in such a good spot. So that's one I'll quickly mention. Another one is on the larger side, we have 7 waste heat boilers, waste heat recovery units that we've installed, including the brand new ones that we're just installing at our Pipestone North facility. Each of those reduces 1,000 tons per annum of GHGs through the better use of heat and the reduction of fuel usage. And so that's just 2 very simple examples. There are a number of other ones I'll throw out would be, just as an example, we're working towards zero emission pads by supplying instrument air from our compressor station directly to the pads, so there's no pneumatic use except for air there. And so that's just a couple of examples amongst many. Given the time we have, I'll just stop there. On the social side, there's a number of things there, and it varies where you are. In Canada, a big one here is trying to get the First Nations representation within our industry increased as much as possible. And so we focus very hard in the areas where we operate with the First Nations bands in the area that not just on reserves, but also in their traditional hunting territory, which covers like 60 miles in many cases. And so what we do very, very much is consult with them. So they come in and check to make sure that we're not disturbing any historical grounds, because that can easily happen if you're not being careful. Number 2, we provide a bunch of donation type funding to try and support initiatives like education, et cetera. And number 3, we favor hiring of First Nations businesses so that they can build their business as we build our business in partnership. So there isn't a lot of time here. I could go into other things, but that's just a quick example of one that's quite at the forefront in Canada and certainly for NuVista.
One last question before we go. What are your thoughts on M&A and consolidation up there in Canada, specifically to the Montney?
Yeah, we're starting to see it happen. We've been expecting that for some time. I think it needs to happen, and we want it to happen, and we want to be on the front foot with that as a company as well. So a couple of things. First of all, all of us from a capital point of view are a lot less relevant to the average investor today than we were a couple of years ago, just because capital levels have dropped so far, share price levels have dropped. So even just getting bigger and becoming part of the indices is actually much more important now than it was. The important thing is, as we look for merger opportunities to become bigger in that way, you've got to do it without diluting your asset base. And that's not easy because we have one of the best asset bases in North America. But it can still be done. There are peers in the area who have excellent assets. And if we can start looking at amalgamations, make the companies bigger, you can get all those good old fashioned efficiencies of reducing G&A. Even though Canadian companies and NuVista have a very good G&A right now already, it can still become better, and in getting some of the capital synergies of working nearby. So I think it's important, and size matters as long as you're getting better while you get bigger, not just getting bigger for the sake of it. Now that said, we've seen it finally starting to happen in the last quarter here. We've seen a number of M&A occurrences starting to happen. And a big part of that has been companies who really had to do something because of their debt position. And that's why that liquidity I talked about, having the cushion that we have had, is very important, so that you can only do the opportunities that really suit you best and not be forced into something. So I think that's the next round we'll start seeing in the next 6 to 12 months, is ones where it makes total sense, but companies have choice. And we have choice. We're interested in becoming better as we become bigger here. And I look forward to seeing how that goes over the next year.
Jonathan, I got to thank you for participating in the Oil and Gas Conference. Thank you for the presentation and the discussion. And want to make sure folks know that you're available for one-on-one meetings. They can certainly get online and schedule those with you today. And I think you have some availability as well tomorrow. So want to encourage people to do that. Thank you for your time, Jonathan, and have a great day.
Thank you, Dan, and thanks to Entercom.
You bet.